In today's video, I'll be covering tax and Bitcoin, some of the things that I think you should be thinking about from a tax perspective when it comes to Bitcoin. Okay, so today I'm going to be talking a little bit about tax and some of the things that I would be considering if I was buying Bitcoin. Now, of course, I'm not qualified to give you any specific advice. I don't know your personal circumstances, and I'm not a financial advisor or licensed financial professional. Most importantly, I think it's important for you to do your own research. Tax is just one of those things in life. Much like death, it's completely unavoidable, it's a certainty. And so the goal here is tax minimization, not tax evasion. The former is legal, the latter is illegal. And so I've taken it upon myself to actually go and learn as much as I can about the tax laws that apply to me here in Australia, and I would encourage you to do the same. So with that being said, let's jump into my top 3 tips from a tax perspective when it comes to buying Bitcoin. So tip number 1 is don't think that you can outsmart the tax authorities. Whether you'd like to admit it or not, the tax authorities have the ability to find out any information they want about you. They have access to all your financial data upon request. And so it doesn't matter whether you're living in South Africa, in Australia, or the US for that matter. The tax authorities are typically some of the most efficient and effective at getting information that they want. So I would probably dispel the idea that somehow you can hide your crypto gains. I would say you should rather be focusing on minimizing your tax burden as opposed to trying to avoid tax altogether, because I think the latter is quite literally impossible. So when you bought your Bitcoin, you would have probably done so through a centralized regulated exchange. They've got a financial services license, which requires that they adhere to certain regulatory standards within the country that they operate. They would probably, and this would apply in most countries around the world, require you to have so-called KYC information, which is know your client. They need to know who they're dealing with. And so you probably gave them your passport or your driver's license. You have to give them some form of official ID. You probably need to give them your address. And so all the tax authorities have to do is go to the exchange where you bought it and say, hey, can I have some information on this individual? And they will give it. The burden will be on you to prove what you've done with the Bitcoin. And so the prospect that you're going to find a way to avoid paying tax on your Bitcoin is virtually zero. You might be able to avoid paying tax altogether, but it certainly wouldn't be legal. And so I would say the goal should here be to reduce rather than eliminate tax. Tip number 2 is find out how your government classifies Bitcoin. Broadly speaking, and this is on a very high level, there are 2 main ways that they've classified Bitcoin. The one is as an asset and the other as a currency. So let me talk about the asset side first. Most countries have adopted the view that Bitcoin is an asset, much like a share, much like owning a physical property, a personal use asset. And therefore, if you've bought and then it's grown in value and you sell and you've enjoyed a capital gain, usually you will be liable to pay capital gains tax. Now, I say usually because there are jurisdictions such as Singapore where there is no capital gains tax on certain types of entities and companies. But if you're buying as an individual, typically you will find that you are going to be liable for paying capital gains tax. The way that tax is actually implemented differs depending on where you are, of course. So in some places they'll have like a flat capital gains tax rate of 10%, 20%, whatever the case may be. And in other places they'll tax you at your marginal tax rate, which is basically the highest tax rate that you pay as a taxpayer. So to give you an example, from 0 to say $20,000, you're paying 18%. And then from 20,000 to 40,000, you're paying 27%. And so your marginal tax rate is going to be the highest of those tax brackets that apply to you. So in Australia, for example, the highest marginal tax rate is 45%. And what that means is that the ATO, the Australian Tax Office, effectively is entitled to 45 cents on the dollar for every dollar's worth of capital gain that you make. Now, there are caveats there. There are also ways and means to reduce that legally, but that's just the general rule that I wanted to sort of outline for you. The other way that countries have treated Bitcoin and classified it is as a currency. In Germany, for example, they say that it's a currency, and so if you've held it for more than 12 months, there are no capital gains. And so as someone who would be living in Germany, I would be buying as much Bitcoin as I can, because as long as the rule is what it is right now, as long as you hold it for more than 12 months, you're not going to be paying capital gains. Tip number 3 is figure out which legal entity makes the most sense for you to purchase your Bitcoin in. There are a bunch of different ways that you can buy Bitcoin. You can buy it as an individual, or through a company, or through a trust, or you can buy it through a self-managed super fund or a pension fund. And each of those have different tax consequences. Now, I'm certainly not in a position to give you specific tax advice in each of those instances, and you need to take into account your personal circumstances and the rules that apply within your specific jurisdiction. But what I can do is perhaps give you some broad guidelines as to how things operate here in Australia, and it will give you a bit of a flavor as to some of the things that may be applicable where you operate. So in Australia and in many developed countries where they've treated Bitcoin as an asset, not as a currency, they say you have to pay capital gains tax on any gains. However, if you've held it as an individual for more than 12 months, you're eligible for a 50% capital gains tax discount. So what does that mean? It means that effectively you can take the gain and cut it in half. So if I bought a Bitcoin at 10,000 and sold it at 20,000, I've got a 10,000 gain, I'm only going to pay tax on the 5,000, not on the 10,000. So there are certain circumstances where it makes sense to buy as an individual. Some people like to buy as a trust. Now, the benefit of doing so through a trust is that the income or the capital proceeds can be split amongst numerous beneficiaries. Each beneficiary has its own marginal tax rate. This gets a little complex, but it's not that bad. So from a tax planning perspective, what a lot of people have done is set up trusts that purchase Bitcoin, and then when they sell, they distribute those proceeds to the beneficiaries in such a way as to optimize the tax so that they pay the least amount of tax. It's a very transparent and legal way to do things. Those individuals have also got a benefit in terms of the 50% capital gains discount. And so that has proven to be a very tax efficient structure for people who have got families and the like. Now, it's not relevant for everybody and it's not going to work for everyone. So obviously you need to do your own due diligence. The other way that people have done it is through companies. In Australia, companies are not entitled to any capital gains tax discount. So you pay on the full amount. And so you will be paying tax. If you bought your Bitcoin through a company, you'll be paying it at a flat rate based on the capital gain itself. In Australia, depending on the size of the company, between 27.5% and 30%. So you will be paying that over to the tax authorities. The last way that people have done it, and this is also probably the most tax efficient, but it has some downsides, is buying in a self-managed super fund or a self-managed pension fund or a IRA in the US, and there's various other versions of it around the world. And typically it means then you're buying Bitcoin through this entity, but you're locking it up and you don't have access to it until you retire. And so to me, I personally have not gone that route simply because I wish to have access to it when I want it. But from a tax perspective, it's fantastic because in Australia, for example, you pay 15% on the way in and the gains are tax-free thereafter. So for somebody who's got a very long-term horizon, who sees that they have absolutely no requirement to access their capital for another 20, 30 years, it could be a very, very good way to minimize tax. So do your own due diligence, but those are broadly speaking some of the ideas that I would suggest thinking about when it comes to whether you should be buying in your personal capacity as a company through a trust, or whether you should buy through your pension fund, IRA, or superannuation. If you found the video helpful, please like, share, and subscribe to my channel, and leave your comments down below so I know what you think, good or bad. Also, let me know what you want me to cover in the future. I love to hear about what the community is going through. I want to know some of the pain points. I want to hear about all the different trials and tribulations within the Bitcoin space. It's a minefield. I get it. I spend 24/7 in it, but I know for people that are new, it can be really overwhelming. So reach out at hello@thebitcoinshepherd.com if you've got any questions, comments, or any topics that you want me to cover. Otherwise, until next time, friends, keep hodling, and we'll see you again. Cheers.